Hi there and welcome. My name is CCP Zipporah Njoroge, and I'm taking you through this session as a second session. The first session is about introduction to credit management, and I want to hope that you have looked at it. Since it is a free video, it should be the starting point before we can proceed with this second presentation. So I welcome you to have a test and to study together with me the aspect of what we call credit risk management. As we were looking at our previous presentation on introduction to credit management, we looked at the credit phases, the 5 phases of credit. And one of the key areas was on the aspect of credit application, where we talk about credit completion. And credit completion cannot be complete without what we are calling the credit risk management. So I welcome you to this video. You sit back and relax as we go through what we call credit risk management. Thank you for joining us. Hope you shall enjoy. What I want us to look at today, as far as credit risk is concerned, I want us to study a number of issues, and my main component or content for this video, I want to ask all of us to understand the nature of credit. And in the nature of credit, I want us to ask ourselves a key question: what is credit risk? What causes credit risk? The consequences of credit risk. And second part, I want us to look at what we call the nature of credit risk assessment. Then we'll talk about the techniques that are used to evaluate credit risk. Then we'll also ask ourselves a key question: which information do we require in terms of credit risk analysis? And eventually, we'll talk about credit analysis process and appraisal. So welcome to our video this day, that we may study together as far as credit is concerned. So the aspect of credit risk, I think the key issue to understand is that credit risk, it is the probability of loss due to a borrower's failure to make a payment. So when you're lending, and when you're in the business of lending, or you're selling goods and services on credit, the aspect of credit risk lacketh not. And in our introduction video, we said that every credit transaction is faced by 2 types of risk. And the risk number 1 was the risk of failure for receiving full payment, or the risk of a late payment. But this aspect of now credit risk, we want to think, how now can we minimize, or what is the probability, so that we can take the right actions as far as controlling or managing the credit risk is concerned. So when we are talking about the credit risk in terms of now lending, we say that it is the likelihood of loss on a financial investment within its life. Meaning that within the life at which you have given the credit facility, there is at some point or some level that you are likely to encounter what we are calling a loss. So the likelihood, we are measuring the likelihood of getting to a loss. So in the life of a portfolio. The other aspect that the things that characterizes what we are calling risk, there are 3 of them, and one of them, the aspect is exposure. So to a party that is likely to default or suffer an adverse change in ability to meet obligation. So what is our exposure? When we are lending, we have to ask ourselves, what is our exposure in this transaction? So it is exposure to the party that you are lending to, or the likelihood of default. And when they default, what are we likely to lose? Then number 2, the other one that characteristic number 2 is there is the likelihood So there is exposure. When you are lending, there is exposure, which is number one characteristic. Number two, the likelihood or the probability that a party will default on its obligation. Then the other part is the recovery rate. In the event that, yes, we all agree we are exposed, and we all agree there is a likelihood or there is a probability, the other question we ask ourselves in risk management is, what is the recovery rate? How likely are we to recover in the event default has occurred? So those are a number of questions that we keep on asking ourselves when we are lending. So those are the three key characteristics that we experience in a credit transaction. So there is the exposure aspect, there is the probability, and if there is a probability of a risk, then what is our recovery rate? What are the chances of recovery? If the chances are very minimal, we make a decision not to lend. But if the risks, the probability or the probability is minimal, then we end up giving or extending credit to that customer. So most of the time, the big question is, what causes credit risk? It is good to know. One of the key things that may cause a risk in a credit transaction is what we call bankruptcy or insolvency. So in the event the customer becomes bankrupt along the way, in the life of that transaction, they become bankrupt, or there's a chance of what we call insolvency. So we are likely to lose. So that is cause number one. So because along the way we may not predict bankruptcy or the issue of insolvency, but it may happen. So that causes the credit risk. Number two, there is what we call cross-acceleration of other obligations. When you are talking about cross-acceleration of other obligations, there's some transactions that may get into default, and the fact that they have taken place, they may have an implication or an impact on the other product or on the other facility, leading to what you are calling the credit risk. And then there is what we call cross default. In this case, we are saying you have a number of transactions, then one of them gets into default. So there is a high likelihood or the high chance that the other product or the other facility will also get into default. Their other cause is what we call the foreign currency convertibility. Probably you had done lending to a customer in a foreign currency, and then now a situation comes that now we cannot be in a position to transact or to repay using the currency that we had borrowed. So that also may lead to what we are calling the credit risk. The other aspect that we need to know is what we call restructuring of loans. That is also another cause that leads to what we are calling credit risk. Failure to repay, the customer just fails to repay. There is what we are calling government interference. So government policies may change, impacting the customer on repaying their loan. This is, for instance, maybe the government brings in measures to stop a certain industry or a certain product being sold in a particular country at a particular time. Then that may also lead to credit risk. It may cause a risk in the facility that you had given to the customer. The other one is market disruption. Market disruption, this maybe could be an entry of a competitor, and the customer is unable to service the loan because the sales have reduced and they are unable to keep to the obligation, or they are unable to honor the obligation as they had promised. So common causes that are key, we normally put them into three, and one of them is what we call credit concentration. This means that you are only relying on a particular industry or on a particular clientele or on a particular maybe organization. Then you have put all your eggs in one basket. So this is very dangerous and may lead to loss. And how do we counteract this? Is by what we call diversifying the business. So for example, if it is a bank and they are lending to maybe to a given industry, let me talk about the oil industry, and the oil industry gets into some sort of problem, that bank or that lending institution is likely to get into trouble if the oil industry maybe gets nosedives and gets into trouble. So we usually say it is good that we diversify our portfolio to protect us from an obligor of the same nature getting into trouble. So we are likely to get into a massive loss in case the particular environment or the particular industry or the particular clientele gets into challenges or get into financial challenges. So it's good to have a mix of your portfolio so that you can cover that problem. The other one is what we call the reason that one of another cause that we can regroup is on what we call ineffective credit or monitoring processes. This squarely lies on the lender because maybe probably they are not carrying out proper credit risk assessment. There are no systems in place to check how the lending is being done. There is no follow-up for accounts that have been extended. Maybe probably we are not as careful as you're supposed to be as far as the credit risk is concerned. So we can also say that cause number 2 of credit risk is ineffective credit granting or monitoring processes. So this one, ineffective credit granting or monitoring processes, we can maybe because we have poor policies or we have no policies. We have not done what we call benchmarking. We have no good rating, credit risk rating processes in place. We lack appraisal processes. We do not carry out what we call close monitoring of the accounts, and we are also not in touch with the ground or with the market on what is happening. So this is very important for us to pay attention to. And how do we go about it is, of course, by adopting proper policies, setting benchmarking ratios that are to be used within the industry or within the organization, the risk rating processes to be enhanced, ensure that we have a proper appraisal process, and then we also ensure that we are monitoring accounts. There is what we call pre-disbursement monitoring and post-disbursement monitoring. And also, we should also make sure that we are streetwise by making use of what we call market intelligence reports that are existing. Another cause number 3 for credit risk is what we call credit exposure in the market and liquidity sensitive sectors. So we need to make sure that the customers or the clientele that we are lending to, they are not vulnerable to liquidity problem. Some institutions or some organizations or some borrowers, they have a higher affinity to what we are calling sensitivity to risk. So sometimes we end up losing or being exposed to credit risk by lending to such kind of clients. So this, we normally see that whenever there is a challenge in the market, it also affects the lenders. It also affects other industries in the business. So what is credit assessment in this case? And what when you're talking about credit assessment, basically, we are talking about assessing the creditworthiness to establish if the customer has the willingness or has the ability to meet their obligation. So we are gauging. Remember, we've talked about exposure. We have talked about the likelihood. So we are saying when we are working on what you're calling assessing a customer for credit, we are actually trying to establish whether this customer is willing to repay and whether this customer is able to meet their obligation. Do they have the financial muscle, and are they willing? What kind of a character do they have? Are they of? So, and because we normally say whenever we are extending credit, we extend it on a number of assumptions, and the assumptions are usually that the customer has the intention to pay, the client will be able to pay, and that we also believe nothing will happen to prevent a payment, and that also the character and the integrity of the client is good and it's accurate, and they're going to honor the obligation. So sometimes we end up maybe our judgment on those key areas, sometimes they do not give us the right expectation, or eventually we find ourselves in trouble. So sources of credit assessment information, maybe you'll be asking, then when I'm to assess the customer for credit, where am I supposed to get the information from? I think point number 1 is from the application form. This is our primary source of assessment information, ensuring that the information that has been provided by the customer or by the client is in line with the other information, subsequent information that is going to be provided. So we usually say that the credit application form is the primary source number one for what we call credit risk assessment. Then the other one, we talk about financial statements. These ones are things like bank statements, M-Pesa statements, the issues to do with balance sheet and income statements. You want to establish what is the financial standing of the customer. The other one that we use is what we call behavioral references. That is, you want to check with the other lenders how the customer is behaving. And this we could easily obtain from what we call the Credit Reference Bureau. The other one is commercial references. Where else or who else are they doing business with? Who are their partners? Who are their main customers? Who are their main suppliers? And how are they paying their obligations when they fall due? The other document that we use to assess for credit is what we call company registration documentation. This is where we are talking, for example, if it's a company, we want to see their tax documents. We want to see whether they are registered with the registrar of companies. We want to see, are they licensed to do the business that they do by the right authorities? Then with another way we do assessment is by carrying out personal visits to the client on the site to check the status of the customer. And the other source is what we call public records that are there in the public domain. You want to check, maybe is this customer gazetted for any, maybe they want to close the business. Are they going through any form of bankruptcy or liquidation? So we can get that information in the public domain. Another question, why risk assessment? Why do we carry out risk assessment? I think one thing that we do, why we do it, is to ensure that we are extending credit to clients who are creditworthy, so that we do not lose our investments. Two, this one also, by minimizing risk, we are able to minimize risk and in return increase profitability. Also, another thing is it enables us to improve on recoverability in the event of default. Then this other one also helps us in making decisions as far as collection is concerned, and in line with the allocation of the right resources that are to be used to recover from the client. Then another thing risk assessment helps in, it reduces incidences of bad debts. So of course, risk assessment is part of good credit management. So those are some of the few. And as well, we want to ensure that we are matching the risks taken with the appropriate mitigation measures, like requesting for collateral, security. Maybe it could be a motor vehicle, it could be a house, it could be a cash deposit. So we want to ensure that if there is an aspect of risk that has been identified, do we have a fallback? Then the other one is to ensure that the credit risk is admitted within the levels acceptable as per the company or as per the institution management policy as far as risk is concerned. Then, of course, the other thing is we do it so that we can set out customer performance monitoring, so that we can be able to arrest defaults at the earliest indication or in good time before it gets out of hand. The other thing that maybe we need to ask ourselves, which are the approaches that we use in credit evaluation? There are a number of them. We'll mention them, and one of them is what we call judgmental methods. The judgmental methods, this one, it is based on the assessor's ability, based on their understanding as far as credit risk is concerned. This is mainly on experience, from what is your experience in the past as far as this line of business is concerned. The other number two is what we call expert systems. This one we talk about the judgmental. The judgmental decision is done through designed lending systems and procedures. So there is a system that is enabling in terms of decision making as far as credit risk is concerned. There is another one that we use, which is called analytical model. This one makes use of quantitative data. This, for example, you pick the financial statements, like the balance sheet or what we call the statement of account. You pick the cash flows, and then that data is fed into a system, to derive on a certain outcome, and we are able to make a decision based on the outcome from the analysis of the data that has been carried out. There is what we call statistical model. This one, we use it in terms of, we use it to score the various relationships that exist in a transaction. There is what we call behavioral. We are observing the behavior of a borrower over time to derive appropriate relationship for reaching a lending decision. Meaning, we want to see how has he behaved in the past, or what has been his behavior. Then the other one that we talk about is what we call the market models. This one involves relying on market information and available on financial market prices. What is out there in the market? What is happening? So we use those models to measure, to evaluate for risk, credit risk. The other part that I want us to talk about is assessment techniques, tools that are used, and will not talk at length on this one, but we have a number of them, and one of them is what we are calling the 7 C's of credit. This revolves around the character, the capacity, capital, collateral, condition, cash, control. These controls that have been put in place. So this one is the most commonly used, whereby you want to check the character of the borrower, the capacity, the ability of the clientele, what is their capital contribution to the project, do we have a fallback in the event of default, then what conditions are prevailing, or what is the condition of that product that we are extending to the client. And then the other part that we will talk about is cash. We always say that we need to check on the cash issues, because cash is what will pay off the loan. It is not the collateral, it is not the character, but we need to also pay attention to cash. The other parts, the other assessment tool we use is what we call Campari. This one, we look at the character of the borrower again, the ability to pay. What is the margin? What profit margin are we making from this transaction? What is the purpose of the loan facility? How much do they want to borrow? That is the amount. The repayment, for how long they will be repaying, how much will they be repaying, do they now have the ability? And then, of course, the fallback, which is insurance cover, or what you are calling collateral. The other tool we use is what we call PARSA. This stands for the person, also the character, the ability to repay, the repayment period, again, security, the fallback, how quickly, expediency as far as time is concerned, and of course the remuneration, what are the profit margin for both the borrower and the lender. The other one is what we are calling CC parts. This one stands for capital, the character, capability, purpose, amount, repayment, term, and security. By looking at all these tools, one thing stands out, that it is in our interest to know the person, to know the character of this borrower, to know the ability. There are things that we cannot take for granted. So if a customer does not have the capability, or what you're calling capacity, then we need to be cautious. And if we think he has what it takes, then we need to have a security. And we can see in all the four models, we can clearly see that they each have what we are calling security, and collateral. That is very important for us to know. Then, what information do you need to carry out risk analysis? Very key question. I think number one, we need to know what is the purpose of the loan. Why are you borrowing? Where are you putting in the money? How much money do you require? Do you have the repayment capacity? Then the duration, that is what we call the tenor of the loan. Borrower's contribution into the project, so we should not be funding everything, the whole amount. We also need to consider the security, what we are calling the insurance, the character. I think this we have already looked at, and even the environment, and the projections as far as earnings are concerned of that particular project being funded. Maybe a good question to ask ourselves is asking ourselves, therefore, what is analysis and how can I do this credit analysis? That is the second part of this session that I would want us to look at, so that we can be able to have an understanding of the credit assessment process and the credit analysis process. So probably I need to ask myself, what is credit analysis? What does it entail? This basically, it is analyzing, evaluating an applicant's loan requests so that you can determine now the likelihood, the exposure that is there, and then the chances of default. And then also we say that credit analysis is a method that we use to calculate the creditworthiness of an individual or an organization as far as borrowing is concerned. We also say it involves a wide variety of financial analysis techniques, which includes ratios, trend. So we are looking at the various ratios, maybe in the financial statements, so that we can establish how good the business is and what are the chances of repaying the loan. So the examination we also look at the collateral, and now which is now another source of repayment in the event the customer defaults in the future. So when you're analyzing, we are actually attempting to predict the probability that a borrower will default on its debts, and also the severity of losses in the event of default. This we spoke about when we were starting the video, that you need to check what if there is likelihood of loss, what is the severity of that loss, because some losses are not worth accepting. So we have stages that we use when we are carrying out credit analysis. I think the key 3 stages, we'll just talk about them here. One of the key stage in credit analysis is what we call information collection stage. We talk about information collection stage. We also talk about analysis stage and the decision-making stage. Just as they are self-explanatory. So you have to gather information, you have to collect information from the customers. You need to collect from the customer himself. You need to know character of the individual, the reputation of the organization, what is their financial solvency in terms of the likelihood of becoming insolvent. The other thing is that in information collection stage, you need to look at the transaction records of the applicant, maybe with the bank or with their suppliers, how they have been trading, the repayment history on other services that had been granted. And of course, when we do that, we are able to get some vital information that will help us in making the decision to lend. So let's talk about the other, maybe on information gathering. We'll collect information about the business, why they want the loan, what is the purpose of the loan, is that project feasible, is it a good project that will bring returns. It's also good to ask ourselves, does the borrower have knowledge on how to execute the project that we are going to fund? Because some borrowers, they borrow and they are borrowing for a purpose they have never, maybe they are not experienced in, they have never maybe even worked on. So this can lead into default. Information gathering equally, we also, when we are picking information, we also get information about the recovery process. You need to ask ourselves, where will we get the repayment? What is the source of repayment? How profitable the project is gonna be? What is the payback period? How sensitive is the project in terms of the cash flow and other economic factors that may prevail? What kind of a security are we obtaining? So we should also gather proper information about the security, so that we do not also now have a secondary source of repayment, which now has an issue in terms of selling it, disposing it is a problem. You cannot realize it. So there is no need of having a security that you cannot be able to execute, or you cannot be able to recover your money. The other one is the additional information that you need to collect as far as the borrower is concerned. Now, stage 2, we've talked about analyzing the information. This is checking on accuracy of the information provided. You should also scrutinize the documents that have been provided, the employment contracts, the corporate charters, partnership deed, what nature of a customer it is. Then the other one, you look at other legal documents attached within the application. Then we need to carry out analysis on their financial statements. That is checking on the ability of the applicant in terms of repaying. That is looking at the solvency issues or ratios. You also analyze the financial ratios, how they have performed in the past, how their tomorrow looks like, and the cash flow projection that they have provided. You look at them to check whether they are accurate and whether they hold any truth. And then you also have to analyze the effectiveness of the project, the quality, the purpose, and the future of that project. Because if it's not profitable, be sure you land into problem if the customer does not pay you on time. So if the project is at a declining stage, it's good to know at what stage the project is. Is it at where we talk about peak? Is it at the decline? Is it at introduction stage? So it's important for us to know at what stage are we funding the business, because we know either the business will grow or the business is gonna decline. So we need to be careful on the stage at which the customer is. So after we are done that, you also analyze the probability or the possibility of loan repayment. This is of benefit to us. We want to know what are the possibilities of repayment, and this we can capture it in what we are calling cash flows of the borrower, checking on the cash flows to check whether they have the ability to repay. And finally, in credit risk and in credit analysis, we look at decision making stage. This is where we have looked at the information, we have gathered information, we have analyzed the information. We are now getting to a point of making the decision. So depending on the analysis, the analyst identifies and measures the credit risk associated with the loan application and determines whether the level of the risk inherent is acceptable or not. If the analyst is satisfied that the risk is acceptable and is convinced that the loan will be repaid, then they prepare and submit the documentation for sanctioning or for approval of the loan. So once that is done, I think we either reject or we either approve. So when you're talking about approval, we are sanctioning, we are saying now this is a good loan, let's go ahead and lend. And I think those are the very key stages that we need to know as far as credit analysis is concerned. So I hope that is clear, and we can be able to talk about credit risk. We can be able to identify causes of credit risk. What causes credit risk? We should also be able to know what are the sources of the credit risk that we are likely to encounter. And I hope that enlightens us in terms of credit risk and also what we are calling credit appraisal. And with that, I think we come to the end of the presentation, and I hope the session was helpful. So thank you so much for choosing to listen to this video. Kindly subscribe to the others that are there, and we can continue learning and becoming better as far as credit is concerned. Thank you so much. From Credit and Debt Management, we are grateful. And remember, if you want to learn this course called Credit Management, we also have an institution or a school called Tumaini Institute of Management Studies, where we are teaching certificate in credit management, diploma in credit management, and we are also teaching what we call a certified credit professional course by CASNEB. Thank you so much, and looking forward to host you in our other subsequent videos. Thank you once again.